Stay there, Steve. Our next guest says the Fed will signal the rate cut coming in September, but it's the statement that will do the heavy lifting, not the dot plot. Joining us is Paul McCulley, former chief economist at PIMCO and currently an adjunct professor at Georgetown's McDonough School of Business. And Paul, it's great to have you here on a day like this. So let me just try to unpack this for a second. Today of all days, this divide between what's happening in the market and what's happening in the real world. Markets selling off, especially big cap tech, those areas, we're down $1 trillion or $2 trillion from the peak. But the data this morning, job openings were good. Consumer confidence was good. And as someone who's been bearish on the economy, I have to acknowledge that maybe there's more staying power here than I'd assume. So I laugh because I get on financial Twitter and everyone's talking about more rate cuts. They're all 2, 3, 5. And I'm thinking, but the numbers that we're getting on the real economy show that it's holding up remarkably well. So I'm curious for your thoughts here.
I think the economy is doing exceedingly well. In fact, thinking about it, we're as close to fulfilling the Fed's dual mandate as we've been in a long, long time. We have a 2 handle on inflation. We have a job market that is sturdy. We have an overall good economy. And essentially, the Fed can declare that the balance of risk have come into balance. They've been saying for a long period of time, we're moving towards balance between price stability and maximum employment. But essentially, the data that you're speaking of and the data more broadly are saying we're in balance, which means that it's time to readjust, recalibrate the policy rate back towards neutral. So I think the Fed's not just in a good place, but pretty close to a delicious place.
It sounds like you're echoing Julia Coronado and some of those who say if they want to keep things in a delicious place, they have to cut rates a little bit. But, Steve, let me just throw up this quote from Stephen Stanley this morning, who over at Santander now, who has a really interesting take ahead of Friday's jobs report. He basically says, could the unemployment rate be done rising? Here he says, the one puzzle piece that doesn't fit with the rest, and he's talking about better, jobless claims are decent, JOLTS are strong. The one piece that doesn't fit is the unemployment rate, which has risen for 3 consecutive months. He said, I expect that jobless rate to actually decline in July, which would knock out a key justification for the FOMC to rush to cut. This was the discussion we were having with Zandy the other day as well. Is potential growth higher than expected? In other words, is the economy just not growing fast enough to keep the unemployment rate from growing? But either way, Stephen Stanley is saying maybe. Is it what happens if Friday comes out and the unemployment rate falls?
Kelly, you're not old. You don't look old, but you talk a little bit like an old person here. You're talking a little bit like a person who came up and only understands Fed rate cuts in the context of the Fed cutting to a recession. The economy does not have to be in the toilet for the Federal Reserve to cut interest rates. Let's go back and review, as we say in bridge, the bidding here. We're coming up on 1 year where the Fed raised rates to 5.38% in order to staunch a surge in inflation. Those interest rates, which are far above how much above we can debate any neutral rate, have had 12 months to work into the economy, and we're seeing some signs of that. If you want to have a good economy come December, come next year, you have got to adjust the rate. I'm very much in the Peter Bookvar camp of tweaking. If you only know, and I'm not saying you only know this, Kelly, a Fed that cuts very quickly, slashes rates in the face of recession, it's hard to know a Fed that can tweak the interest rate in order to get, if you put up the chart that I had up earlier, you see that even over a period of a year and a half from now, the Fed will still be 0.8 nominal percentage points above a neutral rate of 3.1%. Over that entire time, at least theoretically, the Fed will be tight.
I feel like this is a therapy session, Paul, but it's not just me. I think there's a lot of us, the millennials, we sort of came, into the market, into the workplace even in 2007. So at the time, I remember thinking, gee, it's looking bad out there. And then when they cut it, yeah, this is, and I think I'm like a hammer looking for the nail. It's going to be another great financial crisis. And it's not. And wise people like Steve and Santoli, they say, look at 1996. I didn't have the luxury. So I'll put the question to you, and Steve's quite right about this. How does the Fed message? Let's say the unemployment rate falls. Let's say the job market keeps growing and they still want to cut. And consumers are still mad about inflation, even though you and I and everybody knows that's a story more from the past than the future. How does the Fed message that rate cuts in a strong and growing, decent economy?
I don't think you should put very much attention on what the unemployment rate's going to do on Friday. It could be up or down a tick, and it really doesn't change the fundamental narrative. The issue with respect to the labor market, it's gone from overheated, unambiguously overheated, now to being in balance. You're seeing that in a whole mosaic of data that is in balance. So that's the good news. And the Fed has been using forward guidance, signaling that it would be doing this tweaking back towards neutral ever since, the end of last year. And the market has taken that on board with a lot of volatility. So it seems we're coming to the time for the Fed to validate its talk. And I think that's what we're doing going forward, is to validate what forward guidance has already done to financial conditions. It needs to do that. And there's also the reality it needs to bring down the short rate, even though the markets have already discounted it, because small business and the lower half of the income distribution actually pay the policy rate. So forward guidance can't bring relief to small business and the lower end of the distribution. You actually need to have the rate cuts. So that's the process that's going on. A post-inflation shock normalization in the context of a sweet labor market.